most financial sort of businesses largely run on trust. And so what do you think about that, especially since we're investing in an even more riskier asset class? How does trust play out for us, and what can we do to build it?
Yeah, that's true. So, see, the thing with trust is that it has to be earned. With more capital, you cannot buy trust. So trust has to be earned. It takes time. And it's like hundreds of small things that you do over time that people start trusting you. So it's not that we have a formula that, okay, tomorrow we can earn trust. We have to be those people who people can trust. So it starts with the intent first. What is our intent? Is our intent to make quick bucks and run? That will create a very different kind of a company. We'll try to do a lot of FOMO. We'll try to kind of get deals which may not do well, but can attract a lot of interest from investors because they're packaged like that. All those things will happen. So trust is very central, but how do you build trust? That is the main question. And to my mind, it starts with intent. If you don't have the right intent, there's no way you can build trust because over time, something will play out and your wrong intent will show up somewhere. So first is you have to have good intent. And only that's a primary thing. Without that, there is no business. There is no trust. Second thing is you need to have patience. Trust cannot be built overnight. It has to be earned in baby steps. At every stage, whenever people have choices, you think about them rather than yourself. You work in their interest rather than in your interest. If you keep doing that, because real intent comes out when there's a conflict. Whenever there's a conflict of interest, that if you are better off, I'm worse off. If I'm better off, you are worse off. In that situation, what am I doing? Am I trying to make calls which are better for us? Or I'm treating you differently, that my intent is that you win eventually. I see at the start, almost every company starts with the right intent, but it is harder to hold on to that intent. Why is it hard? Because you keep coming across these crossroads where you have to make those choices, and we make those compromises, small compromises. Sometimes these are long-term versus short-term kind of compromises. Sometimes it is like slight dilution of intent, slight conflict of interest. We start favoring ourselves, and that's when you start diluting yourself. Your intent starts getting misaligned with the interest of the user or the customer. So at some level, it is intent to begin with, but then having that high bar on yourself that you are not compromising, and nobody makes sudden compromises. Nobody makes these U-turns. Like Google also started with, what was that? Don't do any evil or something like that. Don't be evil. Right? That's how they started. So that was the right intent. Now we can argue whether that intent has been upheld or not. So I think that is one question you have to keep asking, that, am I being true to that? And in this business, there is, the Google's business may still work with the way it is working because their proposition is something else and it is working out. There is no better alternative to search, so everything kind of plays out. In these businesses, all you have is trust. If you don't have trust, nothing else matters. So that leeway, that margin of error doesn't exist. Second is you have to be really, really patient because trust takes much, much longer to build, and you can lose it at the drop of the hat because that gets blown out of proportions and all those things. So you have to be very cautious. Now, in our business, the first thing that we did was that we will bring in deals where we are convinced ourselves. We are putting our own money. Like Vishal and I both are putting our own money, and that keeps us honest. And the interesting thing here is that unlike a syndicate, which is someone's, let's say, weekend or side project or side hustle, there, if they're making some money in that, some fee, they're rerouting that fee as their investment because the fee is coming into their pockets and the investment is going out of their pockets. Here, when Vishal is putting money and I am putting money, the money is coming out of a hard-earned income and savings from there. But whatever the income is coming from fee is not coming into our hands. It is going to the company's hands. And company has its own journey. We don't know, it's also a startup. It's a riskier asset class as you started with. So all those things will play out. So in a way, we are genuinely having skin in the game. Then what else can we do? Like we felt that transparency is another way of telling people that, see, we have nothing to hide. And we are doing everything to kind of bring that out.
And I think the transparency point is good. One way to do transparency is obviously transparent on our front, right? Whatever we're doing, the conversations we're having with the founders, what are our interactions with it, what is our own thesis about the company, we share that. But also the other part, which is transparency in terms of who else is investing. I think in the sense that how's the deal operating, right? So today, one other way to do it is we do FOMO, right? So a classic example let's start with is, let's say there is a round going on, a 5 crore round, and 44 crores are already being committed outside of the platform. Do we start by saying, hey, 80% is already allocated, 20% left, and start with that FOMO mindset? Or just say, hey, 1 crore is our allocation, and here's how it's going from 0 to 100, and then we walk people through that. So a lot of other players might try the first part, but we've been very conscious from day one to make it very easy and very obvious for people to understand how the whole investment process is going. And that's where we started with, even in our first deal, we had commitment cards, which showed every single investor, which showed the profiles of every single investor who was investing in that company, as and when those investments happen. So real-time commitment cards have always been there on our home feed. And that gives people a very clear sense of, okay, who is investing, and also a sense of why they're investing, both those things. So the why they're investing was still not the primary feature until some time ago, but who else is investing was very clearly visible to users.
So 2 points there. See, who also does another thing, that if I know that person, if I can access that person, eventually we'll provide that access through the product. We'll have to build those things. Then I can talk to that person, figure out what is their reason and all. And maybe kind of I learn something in the process, but also more importantly, I'll get to know why that person is investing at my level, at a one-on-one interaction level. But probably that will take time to build. As you're pointing out, the other thing is the why is also very important. And in the why, there are two parts. One we have built, the other we probably built. One is what is my thesis? What is my point of view? And if you see what are good decisions, what the good decisions are when we look at a problem statement or a decision point from multiple angles. What is the user side of the thing? What is the business side, economic side? So the other part of it is the point of view. A good decision essentially is when you look at problem from multiple lens. And the better job you do at it, the better decision is when you look at it from more lenses than less. That is what good decisions are about, right? That's what good people are trained at. What do we mean by looking at things objectively? That I am stepping out of my subjectivity and then trying to have an objective view. A lot of times that objectivity doesn't come naturally. It comes from multiple points of view. So you can kind of dilute your subjectivity and then see it in totality. So this whole feature of thesis, when people are putting up their thesis, there's a lot of work to be done there still, but it's a start nonetheless, that people have started putting their own thesis, that why are they investing? And that for different people could be different things. And that brings out a lot of completeness in that decision making. However, that leaves out the risk part of it. And that's where we have to do more work, which is I'm investing, but I know that this is a risk here. So I'm calling it out. We have that covered in our feed cards and highlight cards. But from a user perspective, if every user starts telling us why they're investing and what is the risk that they see, then the next user can look at it at all those diverse perspectives and take their own call, such that them, in a way, each card is a filter of its own kind. It is adding to that decision making, making the decision making process richer.
So I have a thesis on thesis, but we'll have to check that. I don't know whether it really works or not. My thesis is that the later commitments typically have better thesis on them. And that's probably happening because they have consumed thesis of the earlier committers, people who are already committed, and then they're built on. To your point where you're talking about, once people also start sharing risk, then I think that will also allow people to come up with better understanding of what those risks are, and probably going one step ahead and saying that, hey, I understand this risk, probably there is some more risk that I don't, or there are things that others have not looked at. So more people sharing their thought process, their views on the company, not only helps them decide whether they want to invest or not, but it also helps the entire community as a whole. The entire community becomes better, their process improves, their investment thesis improves, their understanding of risk improves. A lot of things happen because people start sharing their thesis.
Yeah, also
That was just the
totally. And if you see a lot of users we keep talking to, one thing which we had not really anticipated, it was a hope somewhere, but we are not expecting that. There's a lot of learning that is happening through it. Like I was talking to that user, his core point was that I've learned so much by just going through these cards, going through these short videos and all. What we thought, we are just bringing out what we are feeling and what we are seeing in our observations, and you're just trying to make it simpler for people to understand what the company is about in the shortest period of time. They get a good sense of what the company is. But this whole learning part, is another fascinating outcome that we are seeing from people.
Totally. I know a few folks, people who are open with, they are right now at a stage where they don't want to invest because they're building their own startup. They want to conserve capital. They don't want to put capital right now in a risky asset class. So they still come to the app every time there's a deal because they see value coming out of that. They want to consume that content. They understand what other founders are building. They probably want to see what is the perspective that we are bringing from that conversation. So yeah, that has happened multiple times. In fact, that's a constant feedback that I keep getting from founders that I speak to.
So that reminds me, Vishal, there's a founder I ended up meeting incidentally on Monday at WeWork, and he's building something, and we'll talk to him. We'll talk about that company. I think there's a meeting also scheduled, but this was like just 5-10 minute conversation, and I liked what they were doing. So I said, give me a number or take my number, and then we'll just schedule a call. So when I gave him my number, he already had my number on his phone. So I said, how do you have my number? He said, I'm on Misfits community. I said, okay, since when? And so then he gave me a nice backstory. So he was, I think, with Spinny, he was not with Spinny. He was some other firm. I'm forgetting, but he was talking to some of his friend at Spinny, and he was talking about, see, I'm now looking to start, and these are the thoughts I have. These are the ideas I'm working on. So that person recommended him to join Misfits and say that before you start, just be a part of this community, see what is happening, what kind of companies are being funded, how are founders pitching, how is this whole thing happening. And he did that, and he had seen those unfiltered videos. He was saying something about them. So it's good, right? If we thought that we are creating a platform to give access to this asset class to people who have been left out because it is a very non-inclusive asset class. But in the journey, what is happening is we are somewhere playing a very small part in the journey of founders becoming a little bit better in what they do. And if you see what Anurag was saying the other day, we have about 900 odd users. About 100 of the users, when they joined us, they were working in some firm, some startup, some large company, whatever. And now they're all founders. 100 out of 900 have turned from non-founders to founders. Now, it is impossible that we kind of converted them. That is impossible, right? So the likely explanation to that is that they came in, just like this founder I spoke about, they came in because they wanted to start. And then they felt, or maybe someone like that guy at Spinny suggested to them that why don't you do this? And in that sense, think about it, while we are creating this whole platform for our users who are potential investors into startups, it is also somewhere setting ourselves to have better access to startups, better access to founders, better access to what we call supply. And this is the power of network businesses, that when you have more and more people coming in with the same kind of common cause, there will be like, in my life, one of the ways in which we have access to deals is a lot of founders have become friends, a lot of friends have become founders, a lot of teammates have gone out and, built companies, then their friends they have introduced. The whole network is playing out. So that's another interesting part of this.
I think surprising data point, 40 to 50% of the founders that I speak to, they are coming from reference from an existing Misfits member. So they are recommended by Misfits. And most of the cases, they know the process very well. They know what process we run. So the member has already treated them about the process for Misfits. So they, when I try to explain them, this is our process, most of the time they are aware that this is the process will be. But the other question that I usually get a lot of times when I speak to members is, see, they say that, hey, your app is now pretty good. It works well. It is solving for a lot of issues. Whatever challenges were there earlier, those are now solved. The content that you put out for the startup, that is good, top class. Everything is set. Why not just raise a couple of $1 million, go out and aggressively talk about Misfits? Why not just grow aggressively? So, Amit, do you have any thoughts on should we do it now? When should we do it?
So Vishal, a couple of thoughts here. One is, if I was the Amit of 2015, when we started Shuttle, I was that person. Move fast, break things, all that, kind of capture the world. And Avish probably would recall that, like maybe before even Avish joined us, we're like on this thing about 10,000 rides first, then, like always this ride mindset and this skill mindset. Now, couple of learnings from there. One is that this is not that asset class. This is not that kind of a business as we started with trust. So it takes time. Also, maybe this is one way of saying that this business has to be built like this. But the other is the choice. Why did we choose this business? We could have done something else also. It's probably because where you are mentally in your life, what stage, how you're thinking. My guiding principle in life now is gradually and then suddenly. And it is important to respect the gradual part of it. Get exposed to problems, solve those problems through product in a scalable way. Keep seeing those problems more and more and more. So every deal is an iteration for us. It's a cycle for us. We learn a few things. We incorporate that into our product, into our content, into our understanding. And then we try to do a better job of it next time when we talk to founders, when we talk to users, when we talk to developers every time. And that cycle is making us better every single time. I think we are a few cycles away, maybe 10 cycles away, I don't know, maybe 20 cycles away, when the product will mature more and more. The other is this learning when we scale very fast in Shuttle, and then we had to kind of reconfigure and, kind of pivot and pivot. There are two pivots before we landed onto something that was scaling. It is so much harder to pivot at scale or to kind of even solve small problems at scale because they are complex problems the moment scale is coming. My classic example of that is civil engineering. Even a child can build a small house with sand and brick. It's a child's play. But, try to build Burj Khalifa. It's a very complex engineering problem. You have to look at wind and earthquake and all 100 things and, and still that height. And then how do you do it at speed? So I think scale makes it much more complex than we kind of, as founders, believe that it is going to be. So my way of looking at it is that the moment I add scale, I'm not adding scale, I'm adding complexity. So the product has to be that much better to earn it. The second is, there's value, like in the Rapido conversation we are having, that was the learning, right? That capital is a good enabler, but excess capital doesn't work. It's good to have some constraint as a forcing function. And one should raise more dollars, a bigger check when one has figured out a way to convert investment dollars into marketing dollars into revenue dollars into EBITDA dollars. A lot of times we get into this race that, we need to be ahead of others because we somewhere believe that it is a winner takes all kind of a market. And there is a, first mover advantage. Rapido story that we talked about is actually a late mover advantage, number one. Second is most markets are not winner takes all. If it's a proven model, let's say you're building Ola in India and Uber exists, obviously it's a land grab kind of a situation. So this model works beautifully in those cases. So, but I think what I learned about myself as my, shuttle journey was that I will not win the 100-meter dash against other founders. They will run faster than me. I'm not that person. So my problem statement also should not be where it is about faster execution. And there's a difference between running faster and reaching sooner. So some races are won by running faster. And these are mostly replication models, like when we are doing X of India. But when you're figuring things out, the first mover who runs fast usually self-destructs, especially if they have capital. So it's actually better that you constrain yourself with capital. Don't have too many people asking questions from you. Have angel kind of people who are builders themselves and not the institutional VC who kind of is structured differently. They have the right intent, but they're structured differently. So those questions make you operate in a different manner because next month you have to send an MIS, in the next quarter you have to have a board meeting. So you'll operate very differently in those scenarios. So my view is that this is it's a very painful journey if you just have the end in mind and you need to hit the milestones. It's very painful, especially when the PMF is not there because you're fighting and you're not getting any outcome. So you keep putting effort and you are like on a treadmill. But it could be the most fun journey when you're trying to understand the user better, trying to respond to the user, build the right product, right offering, and kind of that chiseling, a rock into a statue. That's a very enjoyable journey also. So one should enjoy it. And if you enjoy it, you build a better product. which people love. If you don't enjoy it, how will you make it that something that people love? It's hard at some level. So you go through that journey, and probably at the right time, more capital. A lot of capital is required when you want to create awareness, not to get transactions. The problem in India has happened is in all the transactional businesses, used capital to buy revenue without having a PMF. And it worked beautifully when you're building a Flipkart or an Ola or a Zomato even or a Swiggy, because those models were established models. When you try to do something new, it has not worked. And 2021, if it taught us anything, it was this: don't scale something that is not fully working. So maybe I'm overcorrecting. Maybe I'm old now. Maybe I'm right. Maybe I'm wrong. But this is the mindset.
Similar line, one another question that I think that is that most of the time you don't have a deal on the black, which is almost like 80% of the month. And my standard answer to them is, see, we have to find something where both Amit and I, we are convinced about it. We are putting it in the if either of us is not convinced, then we'll not bring the deal. Initially, when we had started, we said that even if one of us is convinced, we'll probably go ahead with it. But then we realized that that's where it's slightly more harder to get deals on the black. And we said that unless both of us are investing in, we'll not bring a deal on the black. And since then, there have been multiple cases where either I am convinced or Amit is convinced, or then I'm not convinced, but we've not got that deal. Now the understanding between us is very clear. When both of us are investing our own money, then only the deal. And the reason for that is very clear. We want to be, we want to build that trust with our users that we are putting in our own capital and we have skin in the game. It's not only one person's skin in the game, probably. In fact, most of the team members are also investing now. So now most of our team members also have skin in the game. So we'll always try to bring the right kind of things on the.
Yeah.
So yeah.
So it's funny, in Shuttle, we used to have employee rides, employee passes. So team members would get those passes if they stay. I think Avish also used to use those passes at that time. So in a way, company is giving money indirectly in kind to the team to use the product. Here, it's the other way around. We are paying the same fee. We are sharing the same carry. Money is going out of our pocket. There is no pressure on anyone to invest. Obviously, Vishal and I are like, by design, both of us have to invest, only then the deal is coming through. But let's say for Avish, it is his own choice. And I remember, Avish, you want to talk about that when you had a timeline in mind to start investing in startups and how that shifted?
I think earlier I wasn't sure about investing in startups because obviously given the risk involved, and my view was, okay, once I hit a certain amount of savings or net worth is when I'll get started here. And so that was one. The other excuse was, maybe I'm not prepared. I need to know a little bit. I'll sit on the sidelines and observe. And these are, I think, broadly the two sort of reasons that I stopped. And they were not, that got changed as we went through this Misfits journey together. And while some of that obviously is my bias, as I've seen us evaluating deals. But I think what changed primarily was the idea of building a portfolio, right? If I were to start tomorrow as well, I wouldn't have that portfolio right from day one. And since 80% is sort of the failure rate you should prepare for, you want to start early so you can build out that portfolio and then see winners and losers. The other way that I often also mention to my friends is, even at the smaller check size that I put in, is it going to have any significant impact on my portfolio and on my net worth or on returns? Are they going to make a huge difference? My answer to that is that the way I see it, the first 5 years are just sort of me learning this asset class, because the first 5 years is just me learning this asset class. And then over time, after that is where I really kick in as a investor with my own viewpoint of investing in startups, what works, what doesn't work.